Okay, are we live yet, Kate?
Yep, we've got Rob in the room.
Rob, can you hear me?
I can.
Great. Go ahead and get your PowerPoint up, and I'll give you an introduction. Rob Roy is a professional stock and options trader with over 25 years of experience, a former PGA golf professional. Rob's trading journey has spanned stocks, bonds, futures, currencies, and commodities, ultimately evolved towards a focus on options trading. Introduced to Elliott Wave analysis in 2000, Rob integrated to become central to his approach to the markets. His passion for teaching trading to others has seen him become a seasoned educator for over 2 decades, taking him around the globe, conducting seminars, and sharing his extensive knowledge. Rob has emphasized experiential learning through Trade Alert since 2009, enriching traders' success probabilities with practical insights gleaned from his vast expertise. So, Rob, where are you broadcasting from today? I see bad news bears, theta decay strategy for fallen stocks.
Yeah, I'm actually broadcasting from Florida. We just watched
Florida, what part of Florida?
over near the Cape. So we watched the
Oh,
launch
you
of.
see the rockets.
Yep, saw
You
the.
must be in Cocoa Beach. I have a lot of clients there myself.
Oh, do you? Okay, yeah, that's right where I live.
Yeah, well, we were there for one of the very first SpaceX launches, the
Oh,
Falcon 9. Elon Musk very kindly invited me and my kids to go watch the launch, which we watched very carefully from 5 miles away, lest there be an accident.
I understand. It rattles the windows every time one of
Well, I
those
was going to ask, does it really rattle the windows like they say it does?
It really does, and the sonic boom is when the boosters come back down is pretty amazing. And then
I bet it is. Yeah, they would cause sonic booms. So, anyway, welcome to the Mad Hedge Traders and Investors Summit. Rob Roy, it was a movie, wasn't it? I seem to remember a movie from the 1990s with that name.
you are correct, and I'm actually a descendant of Rob Roy McGregor, which is who the movie was made about. So it was a historical movie for me, and Liam Neeson played Rob Roy in the movie. So fairly famous actor. Yeah, it was a great movie.
All of my knowledge of Scotland comes from Outlander.
Ah, okay. Yeah, that's a very popular show.
All right, so you have until 5 minutes before the hour. Then we'll award our next batch of prizes. I'm going to go ahead and mute myself, and you have the floor.
Thanks, John. Appreciate it very much. And thanks everybody for watching this presentation. And as John said, it's bad news bears. It's a little bit of a play on words, obviously, but uh, most option traders, and that's what we do. We trade options. Are familiar when you buy options, theta is a negative, so we want to turn that into a positive, and that's the idea behind this. And then we have an injection by AI, which is what everybody's talking about these days. We've been doing it for a while, as you'll see through the presentation. So pretty excited to go through and show you this. This is our disclosure disclaimer. Main thing to take away is we are not registered investment advisors in the United States. So anything that we talk about is taken to be educational. You can take a screenshot of this and read it in your leisure, but that is the most important thing to note. So what we're going to cover in this presentation, the genesis of the idea, where it came from. Calendar spreads are one of the primary strategies that we utilize in this presentation or in this strategy, but there are other ones that I will mention as well. Talk about how AI was integrated into it. Obviously, you want to see the results. That's the main thing. And then we'll also show you how you can access this strategy if it's something that you think that might enhance your own trading systems that you utilize. So let's get into the genesis of the idea. One of the things that I noticed over the years, and I've been trading options for 27 years, long time, dates myself, but been around for quite some time. John talked about being out there for the first SpaceX launch. I was out at the Cape for the first space shuttle launch. My dad actually was one of the programmers that wrote the guidance program for the space shuttle. So been around a while. But one of the things that I've noticed over the years of trading is that once stocks have a big drop, and it can be on news, it can be on earnings, whatever, the stock tends to go in a trading range. It goes sideways, almost like it's in shock. You see when you flatline, the line goes sideways, which you never want to see on a heart monitor. But when the stock drops, obviously they're going to spike the IV in the put options. So that's a key that we will focus on as we go through. So we can benefit not only from time decay, but we can benefit from that extra implied volatility that's being pumped into the put options when a stock drops like that. So that's where put calendar spreads come in as an ideal strategy, where you're buying a longer term put but selling a shorter term put. And we all know that the Greeks are more juiced on the shorter term side of things. So I was looking at charts like this and started thinking, what could we do to take advantage of this phenomenon that I noticed that after a stock dropped significantly, and I'm looking for somewhere around a 20% or more drop. How can I profit from this? There has to be a way. We see this all the time, specifically following earnings reports. And then you look at the IV chart, and that's the chart of implied volatility right there. Now notice the upper left-hand corner there where it talks about the differences in the time frames of options. So your short-term options, your front month options are in red there, 7 to 30 days. Look how that spiked. As I just mentioned, they spike the IV when a stock drops like that. But look at the black line. So if you went out 90 days, the IV doesn't spike nearly as high. So that's known as an IV skew, and you can actually calculate that by taking the implied volatility of the long-term option, subtracting it from the implied volatility of the short-term option, and then dividing that by the volatility of the long-term option. That's how you calculate an IV skew. Basically, if you can sell that red line and buy the black line, you see how you are kind of getting in front of the trade, almost giving you a step up on the trade results just from the implied volatility, because it's not going to last. It's not going to stay there. That spike is very short term. And so we take advantage of it at the moment that it happens. So let's go through what a calendar spread is, also known as a time spread. You might have heard the term time spread before. So let's go through and talk about what this strategy is and how it takes advantage of this phenomenon that occurs when a stock drops. So we're going to buy the longer term option. So that was the black line that I just showed you, and sell the shorter term option, which was the red line. Now the net result will be a debit, but the debit isn't that significant because we're getting so much more implied volatility on the option we're selling than we're paying for on the option that we're buying. So we're going to capture time decay and the implied volatility. So in addition to capturing that implied volatility skew, as time goes by, time decay is more severe on the front month options than it is on the long-term options. You've probably all seen a graph of time decay before where it gets really significant in that last 30 days. Now you can do this with all calls or all puts. In other words, you can do call calendar spreads or put calendar spreads, but for the basis of this presentation and the strategy that we use, we focus on put calendar spreads because we're focusing on a stock that's dropped. A question that comes up often is, well, will this work the same if you have a stock that gaps up? So if we're focusing on gapping down and catching that IV skew on the puts, if the stock gaps up, couldn't you do call calendar spreads and capture the same time to, or implied volatility rush? And you can. The problem is that when a stock gaps up, it doesn't necessarily stay in such a tight trading range as it does when the stock gaps down. So that takes away some of the sideways phenomenon that we are taking advantage of. So it's a good question. Technically, yes, but it tends not to work as well. So we focus on the put side. This does create a delta neutral position. So we're capturing theta and we're capturing IV skew. But as far as the delta is concerned, since we're using the same strikes, We're buying a put with a negative delta. We're selling a put with a positive delta. Since we're selling the same strike, it's technically delta neutral. Here's what it looks like on a risk curve. If you've not seen a risk graph before, the left line is profit and loss, so that's the vertical axis. The horizontal axis is the stock price. So when we plot the strategy, you can see there's this risk graph of a short put. That's the option we're selling. When you sell a put option, the most you can make is the premium that you sold the option for. And then you have risk if the stock were to go to the downside. So if the stock stays the same or moves higher, so that's moving to the right on the stock price, you can capture that premium. If the stock goes down, well, that's where the risk comes in. We add in now a long put. So we're adding in protection, because if you sell a short put or sell a naked put, that requires margin. It carries increased risk. We don't do anything that doesn't have limited risk. So everything is a fixed limited amount of risk. So you don't have to worry about margin or getting a margin call and those nasty notes that come from your broker. So we're protecting ourselves by buying a long put, which, as you can see, makes money as the stock goes down. We all know that. So you pay a premium for it, and it generates a gain as the stock moves to the downside. Over time, it tends to move out this curve a little bit, smooth it out just a bit, if you will. But that's the graph of a calendar spread. So when you put those two together, you can see that we have limited risk if the stock moves too far to the downside. We have limited risk if the stock moves too far to the upside. But if it stays in a trading range around where the stock is trading, that's that little triangle part above the zero line, and that's where our gain is realized. So if we were to spend $4 or bring in $4 on the short put and spend $5 on the long put, that gives us a risk of $1, and we can make $2 or more on the position as it moves through. And then there's your break evens. So it doesn't have to stay pegged to the stock price that it's trading for when it drops. In other words, there's a little bit of a margin of error here. So you have a range. So if the stock had a big drop and it's currently trading at $50, and you were to put on a 50 strike calendar spread, you can still generate a gain if the stock drops down to 46, or generate a gain if the stock drops up to 54, moves up to 54. So you can see you have an $8 range there on a $50 stock where you can still generate a profit on the position. Now, the point of the triangle is where the greatest amount of profit is realized. So if the stock does stay pegged to that strike price, the price where it falls to, if that's what we're putting it on, and we are doing it at the money after the drop in the stock, that's where the highest amount of gain will be realized. But I just want to make sure you know that we've got a pretty wide margin here of error where we can generate a gain if the stock just stays in some sort of a trading range. So think about that, an $8 trading range on a $50 stock, that's pretty significant. So we want to keep the debit as small as possible, and we do that by that IV skew that helps to accomplish that goal. We're looking for non-trending range-bound stocks. Calendar spreads are looking for sideways moves, and ideally we want that volatility skew. It's almost always there when a stock drops. As you know, in the world of trading, nothing is 100%, but when you have a stock that drops like that, the IV skews and spikes up almost every time. Now, that skew percentage that we want is 15% or more, and I gave you the formula of how to calculate the skew on your own. So when that formula shows a 15% or more skew, that's like an added cherry on top. I want to be clear that a skew is not necessary because we are capturing time decay. That's the primary goal of the calendar spread, is to allow time decay to work for us. So we're bringing in more time decay on the option we sold than we're losing on the option that we bought. That's the primary scenario of the trade, but the skew is just a bonus. So if you like ice cream sundaes, that's the cherry on top there. Now here's a real example. This was actually an alert that was sent out to our subscribers that gives you a pretty good idea of how this potential strategy works. So you can see this is on Twilio. There is our trade ID. So, it's an actual trade that was sent out. So the stock had its big drop. That's what we're looking for. And then the expectation is to stay in a trading range. And if you're wondering what's that trading range, it's 1 standard deviation. So we're looking for a 1 standard deviation move following the drop. So it can drift up or it can drift down. Just showed you the break evens on the risk graph. So a little bit of a move up, a little bit of a move down, as long as it stays within 1 standard deviation of where it was following the drop. And in this example, the stock did stay sideways. You can see it did drift a little up, came back down, drifted up again, and then came back down right into that trading range that we were looking for. And that generated a 78% gain in a relatively short period of time for a time decay strategy. Normally with a time decay strategy, the more time that goes by, the better. But 78% is a pretty good gain in a short-term option without having the risk of selling a naked option. All right, so that was the genesis. That's the original strategy that I looked at. And this is something that I noted as something that I traded. And then I contacted the folks at the Hub organization, hubb.com, because I heard that they were innovating with AI. And I asked them if there was a way that we could integrate AI into this strategy. And they said, yes, we can do that. So already had decided that using calendar spreads and benefiting from time decay was ideal for subscribers. Talked to the Hub folks, and they offered to go ahead and AI-ify, if you will, the strategy that I had already been using. So I had some really basic indicators that I was looking for, starting with that stock moving to the downside, the IV skew, et cetera. So there was a real basic strategy that I was looking for, but how can we enhance it? How can we improve the performance? It already was a good strategy and performing well, but can we make it better? We're always looking to make things better, aren't we? And so this is where the artificial intelligence comes in. So the folks at Hub took my original scan criteria and results and then added more than 300 data points to what I was already doing. And that was shocking to me because it was, fairly basic, looking for the drop, IV skew, time decay, the basics in the world of options trading. But adding over 300 data points, you can imagine that if you can have a scenario that was already working just with a basic setup and add over 300 data points to it, how much can you enhance the results of the strategy? And it was significant. And so the primary goal here was once the stock drops, their data points were going to give me an enhanced percentage chance that we were going to stay in that sideways move. We were going to stay in that trading range, the 1 standard deviation move. It's a pretty sophisticated algorithm, and they really are data scientists. Oftentimes we hear about, rocket science and stuff. And that's something that we hear about all the time here on the Space Coast. But this is a pretty detailed algorithm, something that I don't fully understand, but I wanted to. So I asked them, can you explain it to me? And so basically the algorithm includes price and volume data, indicator values, comparisons to benchmarks, data rankings, statistical measures, all those things you can find on your own. But it also combines regression-based models and neural networks. That's where we start to get out of my realm of comprehension. I do know from a general standpoint that a neural network is where you give the AI a problem to solve or a situation to solve, and it goes through and it creates an answer, it creates a solution. So you say, here's the set of criteria, find a solution. So that one I actually know, but all the rest of the stuff I don't really know too much. And I did ask them because I'm one of those people that kind of wants to know how things work. And they sent me this. And when I look at that, I was like, I don't really know what any of that means. And then their quote was, here are the most important coefficients for each of the sideways models. The catch is that the final model is a combination of 4. Let's set up a time to go over the nomenclature. And I said, all right, well, go ahead. And ask if they could provide some illustrations to go with it. We all know that we learn in different modes. I'm a visual learner. That's how I learn. Some are auditory, etc. Perhaps you've had some sort of a test on what's your greatest amount of learning or gone through that in school. Well, I'm a visual learner. So I said, can you send me a picture? Because I don't really understand those words. And then here's what it looks like. It looks like a dot plot graph. Some people have said that it looks like an ultrasound kind of result. But what we're looking for is the clusters. So you can see where all the dots are clustered. To me, first thing I think of when I see this is like the dot plot graph the Fed uses that you hear about all the time. But we're looking for the clusters. And so that's just one coding result. And then they sent me a handful of them that are some of their, what they call the top 30 data points. And you can see every one of those creates a cluster. So I'll go ahead and skip forward here to the chart, which shows these are the ones that they felt are the 36 most important correlations that the algorithm uses. So the way this works is you can see the cluster in each one of those. And what we're looking for is where those clusters agree. So you go through and you say, okay, each one of those has its outliers on the dots, but there's clearly a cluster in each one of them. Where do they all agree? You can just start to envision or imagine, I think, that if you come up with this many data points that are all agreeing, you have something pretty special. And the results prove that out. So the algorithm results showed that the stock is forecast to stay in a sideways range. It would give me a score between 0 and 1. And they used over 20 years of market data going from 2001 to August of 2021. And that's when I became a believer and said, okay, let's go forward. Over that time frame, they had found 7,562 signals over that 20 years. And then from that point on, we started sending it out as alerts. So here are the setups. This is what it looks like. And, you'll in general move from the lower left to the upper right. That's what the setup looks like here in the dot plots. And if we have a reading of 75, that's what I want, 75 or better, then we can generate a high percentage of winning trades. So I look for a score of 75 or more, and you can see that the way the scoring works, that also happened to coincide with the highest number of scores. Now, sometimes you get scores higher than that. You can see that the blue graph there, almost a histogram looking graph, scales down. We don't really get to 100%, nothing's 100%, but we get a lot of signals at 75% or higher. And quite often we get some signals that are even higher than 75%. So if you can have a system that can generate 75% gains or be right 75%, let me make sure that I'm clear on that you are correct, profitable 75% of the time, then you have something pretty special. So we send out our trade alerts via SMS and email or both on the AI results. So we look for where's the ratings, look for a 75 or higher score, then do a little bit more setting up of the options, because it doesn't take into account whether the options are liquid. That's not in the AI thing. So you add that part in. If there's no options available or the option liquidity is very small, then we will pass on that one. So we want good liquidity. We want stocks that are easy to get in and out of from an option standpoint. So lots of open interest, lots of liquidity, and we don't want those ridiculously wide spreads that you see sometimes on options, because slippage can affect the return. So there's a few things that we look at before actually just sending out an alert. So it's not just if the AI score is there, the alert goes out. Now we want to make sure that this is a reasonable position that people can get in and out of. So we're looking for stocks that are in a trading range, specifically sideways. A gap down works well, but it doesn't have to be a gap down, a significant drop. The beta decay is going to be there just from the calendar spread. That's going to be there. But then we look for that IV rush into the puts. And then when we sell that short-term put, we are benefiting from the IV crush. So IV rushing into an option is known as an IV rush. And then as it comes out rather quickly, that's known as an IV crush. And we benefit that because we're selling the rush and then benefiting from the crush that occurs after that. So we focused on calendar spreads in this presentation because we have a limited time to present this to you. But I can tell you that diagonal spreads and butterflies work well also, and that's where the options analysis part comes in. What's the best options trade to put on the data that the AI has given us on the likelihood that the stock is going to stay in a trading range? So do a little bit of options analysis to figure out which is going to be our most beneficial strategy. So profiting from time decay, there's the calendar spread. That's what that graph looks like. I showed you the trading range. We have a pretty significant trading range that we can still generate a gain on the position. The diagonal spread is a very similar looking risk graph. There's a tiny skew towards direction, as you can see. Note that on the yellow risk graph, the risk side underneath the zero line goes a little deeper. If the stock goes down than it does on a diagonal spread, if it goes to the upside, the risk is about the same. If it were to break out of that trading range, the risk is the same. But if you use a diagonal spread, you've actually given yourself an even greater probability of potential profit, because if the stock were to break out of the trading range to the lower side, you don't have much risk. And notice that the profit area is expanded, it's wider, so the stock can break lower out of the trading range and still generate a gain in a diagonal spread. So those work well if the situation warrants. And then we also can use a butterfly if it looks like this is a really high score and the butterfly is available. There's good liquidity on all the strikes for the butterfly. That works out well. Butterflies are normally a little bit lower in cost to get in. And you can generate some really significant percentage returns if you get a butterfly that works. But note that they're all very similar in the fact that they benefit if the stock stays in a trading range. So the negative here on the butterfly is you can see the trading range might be slightly narrower. That's offset by the fact that you have a lower cost of entry. So all those things are considered as far as which is the correct options trade to put on, or the best probability options trade to put on. But you can see they all have that green area of profit if the stock stays in a range following the drop. So that's the important key. So the trade selection, first part, looking for that score of 75 or greater, that starts the process. So once I see that, then we look for what's the availability, the liquidity, the cost, any margin requirements. I will tell you some brokers, and I've argued this to the hilt with the powers that be at the various brokers. I don't understand why a debit position like a diagonal that has limited risk and you have protection longer than you have a short-term option should have any sort of margin. I lose most of those arguments. That's just the system has been that way forever. So just be aware that there might be a margin requirement on a diagonal position. There's no margin on calendar spreads, and a select few still charge margin on butterflies, but most don't anymore. But margin is just designed to cover the broker. And I can argue that with a limited risk trade, a debit trade, you can't lose more than a debit. I want to be really clear on that. You put on a debit trade, it's not a very significant debit, and you cannot, no matter what happens, lose more than that. Why would there be a margin requirement? Where is the risk for the broker? But it falls on deaf ears. But sometimes that happens. And if you like weekly options, you may be aware that weekly options can get juiced even more on their premiums. So there are times when, and people ask this question, well, if you buy an option longer term out, instead of selling the front month option, can you sell the front weekly option? And then once that premium is collected, sell the next week. So you could sell 3 or 4 weekly options against a longer term option that's further out and generate a higher gain than you would if you had just sold the front monthly option. And so that's a great question if you were thinking that. And in the scenarios where the options have weekly available and the premium is enough to make it worthwhile, we may do that. And that gives you an opportunity to sell it a few more times within the same month that you would have been looking to collect the premium on the short-term option that you sold. So told you I was going to show you the results. I'm sure everybody wants to see, well, how is this working? Well, there's the returns. So the average return is 41% per position. That's not bad. So these aren't home run trades. This is an income strategy. So it's designed to generate income. It's a good hedge. If you like to trade directionally, then you can hedge yourself. And you can see the shadowed graph here, starting back with the data that finished in August. We started sending out alerts. So these are actual returns from alerts sent out to subscribers. This is not just hypothetical. We sent this out. It's averaging over 100% a year. The cumulative return since the beginning, and that was in September of 21, is 453%. And 78% of the trades are winners. And you can see that's pretty impressive. Normally, if you have a technical trading system where you can generate 60% winners, that's viewed as a good system if you have any sort of decent risk management principles aligned. So the results speak for themselves, if you will. So if you started with a $5,000 account, you can see where you've grown. You're over 25,000 now a few years later. So 453% is the cumulative return. And it's not compounded, by the way, just to make sure clear on that. So if you stay with the program for a while and you start putting on larger positions, that's up to you. But we add new subscribers all the time. So it's not fair if we base those on compounded results and put on larger positions. So we base it on a $5,000 hypothetical account each time. Every single trade is based on that. And we don't put more than $500 of risk per position. So no more than $500 of risk in any one position. And that goes through no matter how long. I mean, when you go back, you've seen the returns since 2021, and we still only do $500 of risk. If you want to do more than that, that's up to you. Earnings announcements obviously move stocks. And if we're looking for a stock that drops, you're going to see that on an earnings report, more than half of the alerts that come out are derived from a drop following earnings, but not all. And 56% might be a little bit lower than what you thought. So sometimes we actually put the position on through earnings, and other times it's in between earnings reports. In other words, there was some sort of a news event that came out, the stock dropped before we get to the next earnings report. So that's kind of what we're looking for as far as the difference on when we put the positions on. But primarily, it's going to be following an earnings report. And there's the win ratio, depending on when it was sent out. And surprisingly, between earnings reports is the highest percentage, rather than on an earnings report or holding it through it. I think holding it through it being just a little bit lower probably makes sense, but it might be surprising to know that some sort of a news event in between earnings reports actually had a higher win ratio than those that followed the earnings report. Just, sometimes data surprises you a bit. So how do you access these time strategy alerts? How do you go through and how do you take advantage of this? Well, at Elliott Wave Options, we go through and you learn trade by trade. So we are educational. We look for the scans. What are the AI results? And then we go through and say, okay, where's the candidates? From there, do the analysis from what the results are. And that's on the option side, looking at the options, figuring out what strategy is best. And then if it's determined that this is worthy of sending out an alert, they're sent out in real time. So it's going to be during market hours, obviously through SMS or email. So we do send it out based on live market events. And then we don't stop there. We want you to learn how to manage the trade. So we don't just send out entry alerts and then you're left on your own to take it from there. So we go through and every time a new alert is sent out, it's added to our website at ewotrader.com. And this is what it looks like. Every single one of our alerts has a page that looks just like this. So you can see that it tells you what was the strategy, the entry date, the exit date. There's also some commentary on what was the criteria that we were looking at for entering this, and you get the risk graph. So what did the position look like when we put it on? So all that information is there on the website for each and every alert that goes out. And alerts are sent out for entries, exits, and adjustments if anything is needed. So here was an example here for Dynavax. You can see that we had the drop. Notice that wasn't a gap down. It doesn't have to be a gap down. So we kind of were in a trading range here between support and resistance following the drop. That works out really well. Like it when they set up that way, and you get that information in the chart. Look at every position every single day, obviously, and if anything's needed to be done, exit the position or adjust it a little bit. Sometimes we might take the short off and hold the long. There's different things that we can do if the stock looks like it may break out of the range. And that's been extremely successful for us doing that. So you get the analysis regardless of what we're doing. We go through and tell you on every single position. And then you have the ability to ask questions. And you can do that a number of different ways. You can send questions through support. We actually have support staff 24/7 that's available to answer questions that are emailed in through support. And also do a live show a couple times a week where questions can be asked live instead of just via email. And you can do it by voice if you want, or just type the question in if you're a little bit nervous about getting on a voice type of a question. So every trade every week on that insiders meeting, that's what it's called, that we do on Thursday nights, and we do EWO Trader Live on Mondays. So we start the week and kind of end the week, and we'll go through and talk about every one of these positions that have information needed to share with you. But this is what the page looks like that has all the information on it. So a breakdown of exactly what the strategy is, what the entry alert was, the reasoning, the graphs for entries, exits, every single one of those alerts, and any sort of alert that's sent out, even an exit, has all that detailed information. Why are we getting out then? That's one of the most difficult things in the world of trading, isn't it? We get in a trade. How do we know when to get out? When have we made enough gain? Could we have stayed longer? Should we have gotten out sooner? Those are all things that are troubling, especially for newer traders. And so we guide you through that and explain why. And that's probably where I get the most questions that come out, is why did you exit at this point in time? That's a big learning tool as far as what was the reasoning for getting out. And there's things that you notice over 27 years of trading. I've been doing it for a very long time. I mentioned I only had 2 careers in my life. The first one was a golf pro. Second one is trading options. That's it. That's all I've done in my entire life are those 2 things. And they both kind of are the same as far as the fact that you find out every trade is different. Just like when you play golf, even if you're playing the same exact course every day, every round is different, right? Because you're going to be in different spots. You're going to be hitting different clubs. They're all different. So if you like that access to Q&A, we go through, talk about the markets, we talk about the positions, and then we leave plenty of time for a Q&A. So if you have a question about a particular alert, or if you have a stock that you just want to talk about, we can talk about those as well. So available multiple times a week to go through and talk about what's going on with the markets and the positions. We pride ourselves in our education. We have a lot of education online. Do a lot of Elliott Wave. I'm a believer in Elliott Wave myself. I'm a believer that those that have not had success with Elliott Wave haven't taken enough time to learn the intricacies of it, because it is pretty intense. There's a lot of pieces to learn. It's not just the general stuff that you see out on the internet. There's a lot more to learn about it. And so with the trader education, we have video and text. We have courses that are premium that are included. We have mastery classes that are actually in addition to the regular subscription, where we take deep dives into the strategy. But we talk about our 3 primary strategies that we utilize the impulse strategy, which is AI-based, volatility strategy, which is looking for breakouts of triangles. That's actually how I made my name in the world of options. Somebody found out about that strategy and how I apply the Greeks to it. Very specific strategy for taking advantage of that. And then the time strategy that we've been talking about. So you have education on all your different strategies. We have education on Elliott Wave. If you feel like, well, I've looked at Elliott Wave, I haven't really been that excited about it. Well, go through and go through the in-depth part of Elliott Wave, and then I think you'll learn a little bit more, and it might make a little more sense to you. We also have an options boot camp as well, so you can understand the Greeks, you can understand the analysis that goes into the options side of things on whether it's a calendar diagonal or a butterfly that's put on. So they're set up, the classes are set up just like you would go to a college course. We encourage you to go in the order that they're set up. You don't have to. If there's a specific, particular or specific subject that you're interested in, you can go directly to it, but we encourage everybody to go step by step through their education. And then we talk about some of the confirming indicators that I like to apply along with. It's not just Elliott Wave. I don't think anyone that has a technical trading system should focus on any one single indicator. You want a technical trading system. So we go through and talk about those indicators that are part of the general system that I sent the AI. But I want to be really clear. The data scientists don't give us the algorithm. I get the results of the algorithm. That's theirs. It's proprietary to them. We have a contract with them. They can't go to anyone else. So people ask that, well, what if they decide they want to go give this to everyone? Then it's not going to work as well, right? And probably not. But they can't do that because we have them locked up by contract. So we're the ones that get the results and nobody else can. So how you can receive it, the time strategy monthly subscription is $149, which is a great value, including the alerts that are delivered through SMS and email, the analytics, as I mentioned, for each and every trade, the access to me and our other traders at ewotrader.com through the insiders meetings, live Q&A, or emails at any time of the day, and the premium education courses. So you have access to all that education, and you can watch those courses as many times as you want too. There's no limit to it. In order to preserve the effectiveness, we are limiting the number of people. I talked about how the data scientists can't send this to everyone else with the algorithm, so they can't share the algorithm with anyone else, and we don't want everyone under the sun taking advantage of this either. We don't want to be moving the market when we see these results, et cetera. That would take the skew away if we were to do that. And some of the primary reasons that you might want to consider us is it's easy to get started. So it's just a monthly subscription. We don't have a yearly commitment to it. We have the education at no additional fees, access to asking questions through email or talking to me, and you learn with a mentor. I had a mentor when I first started trading, and it was unbelievably beneficial to have someone that's been there, that's done that, and helps to guide you through things rather than just being out there and trying to learn on your own. So following somebody that's been through the movements, the ups and downs, and all the different news events, etc., is tremendously beneficial. And we publish our track record. You can see everything that's listed there. So we're literally walking the talk. So the idea here is we want to educate you on how to do these things on your own. That's our primary goal. And my goal is I wanted to educate the average person. When I first left the golf business, I was a registered investment advisor. I lasted 2 years doing that because I felt like a lot of the investment advisory firms were more concerned with how the company did rather than how their individuals did. And I wanted to help the average person. I consider myself an average person. I don't have a Harvard MBA. I have a college degree, but it's not a Harvard MBA, and I was a golf pro. So if I can do this, you can do this. But we give you the opportunity through the alert service to earn while you're learning. So you follow along with the alerts. The historical results are there, and it helps you to offset the cost of your education. So you can generate gains as well. So all that stuff is included. And as you could imagine, there is a special for the Mad Hedge event, and you can take advantage of that for $89. And it says that it ends March. That's not correct. So that ends in July, and that will give you the opportunity to be locked in to that price of $89. So that initial amount was the SMS, chart analytics, the Q&A, premium educational courses. All that's a fantastic value. But we're going to throw in the mastery courses as well. And normally our subscribers have to pay extra for that, but as an added bonus, you not only get the savings, you also get the mastery education for free. So if you're really serious about taking a deep dive into the world of options and Elliott Wave and technical analysis, this is a good place to be, and great offer to take advantage of it. You can see where you can go take advantage of this offer at ewotrader.com/mad-hedge. So ewotrader.com/mad-hedge to take advantage of this opportunity. And again, you are grandfathered in as long as you keep your subscription active. So great opportunity to take advantage of all this. And I talked pretty fast because I know we got a little bit late on the start. If there's any questions, I'd be happy to take those now, or can turn it back over to you, John. If anybody has any questions, I'm happy to answer them. Let's see if I can go through and access the.
Okay, well, that was outstanding. Just remind me never to enter a golf tournament against you in the future.
Well, I got my amateur status back now, so I'm not a classified professional anymore, so that I can.
Yeah, I'm not sure I want to play an ex-professional amateur either. Certainly, I wouldn't want to be betting on it.
I do enjoy playing golf, and it's great to be able to go out and play for fun now. I'll say that, and it's amazing how much better you play when your livelihood doesn't depend on it.
It is, isn't it? Tell me how far along. What kind of ranking did you get to?
The highest, or I guess the lowest, depending on how you view it. I never broke the top 100. 141 was the ranking, but still, third was my best place finish. I won some tournaments, but they weren't. I've won tournament. You're going to get a kick out of this. The tournaments that I've won is while I was an amateur. My highest place finish was third in a professional tournament, but I still had a great time.
What was your best ever score?
66.
Wow, that sounds pretty professional to me.
Yeah, I shot 66 multiple times, and it's I just couldn't get to the point. I've made more than 6 birdies and plenty. I made 10 birdies in one round, 9 birdies in another round, and still could only shoot 66. So I always would throw in an other. There would be just one of those holes that would get away from me and cost the bottom line score. But I putt pretty well. So I make a lot of birdies, but then I make a few mistakes gathered in there. But yeah, I just couldn't break that 66. Shot it multiple times, but couldn't go lower than that.
Yeah, you're talking to the 1975 champion of the Foreign Correspondents Club of Japan golf tournament. And the reason I won is because I had a handicap of 36. I was the worst golfer in the club, and I shot a lifetime high of 88. So that won me the trophy, which was a cigarette box with Foreign Correspondents Club of Japan engraved on it, which I still have, and which I had have my cleaning lady polish once a month. So 88 minus 36. 36 is the maximum allowable handicap in a tournament, and that gave me a net score of 52.
That's going to be tough to beat.
Beat the pants off everybody.
I can
grumbled about that for years.
Oh yeah, I'm sure you've been called a lot of sandbagger type names throughout the time.
Absolutely.
Yeah, absolutely. Yeah. Yeah. No, I would have been giving you a hard time as well.
Yeah,
Shooting.
and rightfully so. Okay, well, thanks very much, and I hope you come back and join us again sometime. Let me go on to the prizes. To take advantage of Rob's offer, click on the chat box on the right. It says ewotrader.com /mad hedge. There you can take advantage of the discount offers that are only available today.